Hello, everyone. Welcome to another edition of Let's Talk Tax. Today, I'm joined by my colleague, David Seibel, principal of our R&D tax credit practice. Welcome, David.
Thanks for having me, TJ.
I thought, David, because what's dominated our lives the past 2 years, especially within our R&D tax credit practice, which you lead, is the whole issue of 174. And so, as we're here looking at in the fourth quarter of the year, obviously, year-end tax planning is paramount for a lot of our CPA firms and their clients. And so I wanted to kind of talk about maybe what our thoughts are on 174 for the 24 tax year and what it looks like maybe beyond, as well as what kind of corrective actions can there be for our clients and CPA firms that haven't been taken. We can touch on that a little bit later. So, David, based on what we're seeing with the industry experts and our elected representatives, what is our counsel to our CPA firms for the 24 tax year as it relates to 174?
Yeah, TJ, as we go into gearing up once again for another tax season, for now, we're not expecting 174 to change. So the required 174 amortization, we're preparing for it as such that it will not get changed. Obviously, there is the possibility that it can change and we can remain hopeful, but we're certainly not going to expect it, certainly after the last couple of times that it just hasn't come to fruition. Again, I think we can be optimistic, and it's very possible that this could be one of the first orders of business, and in 25 could be a tax package, but it's currently unknown as to how 174 will play into that. Big part of that is it going to be retroactive? Because that's obviously going to substantially add to the price tag of any sort of tax package. So again, there's still plenty of unknowns as it pertains to if there is a fix. Would there be retroactivity? What that would all look like. So again, considering currently it is the law, we have to go into the 2024 tax filings as if it's not going to get repealed.
Yeah, David, I would agree. I think given the tone of Senate Republicans after the House passed the 174 amortization repeal bill earlier this year, Senate Republicans seem pretty determined to address 174 as part of a larger tax bill that serves as an extension or replacement of TCJA. It just didn't give me a lot of optimism, and I really think that very unfortunate. You and I have had on previous LTT podcasts, we talked about how the punitive nature of 174 and what that means for businesses. I think, fortunately, and I don't say fortunately in a good sense, fortunately, and from a timing standpoint, I think there's little uncertainty related to 174 for the 24 year. I think the position we've taken is that it's here. It's going to stay here for the 24 year. As you said, hopefully it's dealt with in 25. I just don't think the making it retroactive is on the table. It's just the expense is too large. I know that a lot of times last year we were in the middle of tax season that people were holding out hope, so we got to, we were kind of cranking through our 41 studies, our 174 studies, and we got to April, and some clients and CPAs were holding out hope that it was going to get a fix, and unfortunately, just the fix never came. I don't think it's going to be there for the 24 year.
And I think something we can point to that is just the IRS guidance. Way back in 22, when this was actually going to be implemented, we had very little guidance because I think at the time, everybody, including the IRS, thought that this was never going to happen. So then, last September, we had the guidance that came out to help taxpayers navigate on what should be 174. And we've also heard from some other IRS sources that there's going to be continued guidance coming out possibly later this year in 24. Again, just to provide further clarification on certain items that the guidance last September didn't, just of September of 23 didn't, leading us to think that 174, again, the IRS's position is that 174 is probably going to continue to be the rule of law for 24.
David, I think, and I completely appreciate what you're saying. I think that it's something that, we always viewed it as this temporary thing. And now I think we're going to see that it's permanent. And the great unknown is how the IRS is going to look at 174, how they're going to flag for infractions on 174. That's kind of the unknown. We've always talked for the past 2 years. We talked about this trapdoor, for
Mm-hmm.
companies that took the R&D credit for all these years, basically waving a big red flag saying we have 174 expenses, and suddenly in 22 they took this drastically different approach to, well, no, I really don't do R&D. What
Mm-hmm.
is Have we seen anything with the IRS? Have we seen any audits so far that has brought into this 174 amortization requirement into play?
It's been pretty rare. We have seen one audit come through, and it was not a client that we did, where 174 wasn't stated appropriately, at least as it relates to the 41 expenses. In this instance, the 41 expenses were a lot higher than the 174. That is still something that is continuing to play out. So we're not sure of what exactly is going to come of that. But as we continue to progress into, the more that 174 becomes law, the intent there was that this law was going to be a revenue raiser for the IRS or for the government. So it makes sense that the IRS would be enforcing compliance with this issue just because of the dollars that can be at stake there, particularly when you look at the IRS guidance of what is expected to be amortized under 174. So it's something that we that we expect will be continuing to be a point of emphasis for the IRS once they have all of their statistics laid out and decide on the appropriate metrics to pursue some of these examinations for those certain taxpayers that were conducting 174 activities.
Well, obviously, the great majority of our recurring client base regarding our R&D tax credit practice has engaged us, or at least has been taking 174 amortization. They continue to take the credit, and they continue to obviously now amortize 174. And while it's been extremely punitive, obviously in the 22 and 23 year, they're in compliance, and we try to assist them as best we can on giving that counsel and helping them with those calculations. But there's this other bucket that we've talked about in recent weeks, David, is that there's the clients that haven't taken the credit. And you and I sat and talked about it, is that there's the clients that are kind of more of the rogue gunslinger kinds that say, hey, I'm not going to do it. I'm not taking the R&D credit. I'm not taking 174 amortization, and I'm willing to run the risk. And there's this other group of people that simply thought it was temporary. And there was going to be this fix. And they realized that, hey, listen, I'm going to roll the dice. They're going to fix this, and that way I'll just bet they're going to fix it. We've kind of developed this roadmap. We've come up with this protocol to correct them, because there is a path for those companies that want to be in compliance. They want to reduce their exposure in the event of an audit. They took the credit through 21 tax year. They kind of parked it for 22 and 23. Can you kind of walk us through a little bit of what that corrective action looks like for those companies? Because there is a path. And we believe that it's not as punitive as one would think when you look at the overall credits that would be generated and the timing of the amortization.
Yeah, certainly. So 174, the IRS said, is a change of accounting method. So those taxpayers that were able to be in compliance that very first year, they had the option of filing a very simplified change of accounting method statement. But that had to be the first year after 174 went into effect that was an option. After that, you have to file the normal longer form 3115, which with that, you have to make a positive 481A adjustment. As you mentioned, TJ, it's not as punitive as one would believe. Rather than having to take the hits that would have been there for 22 and 23, all in 24, in addition with the 24 hit, there's the option of spreading out the 481A adjustment over 4 years for those 22 and 23 years. So it's, again, not as punitive as one would believe initially when trying to get into compliance. So it's a nice little avenue for those taxpayers that, again, to your point, want to be in compliance, but maybe are a little fearful of the additional taxes that could be generated. And then as far as the R&D credit is concerned, it can be a valuable tool to help offset some of that tax liability. it's a little counterintuitive on how you would actually do that, because if you're trying to claim the credit for the years that you didn't, the situations where they said, oh, well, I'm not going to claim the R&D credit or 174, there's still the opportunity to go back and amend to claim the R&D credit for 22 and 23, but you would not do any adjustments on the 174 figures for those tax returns. You would just simply capture those on the 481A adjustment for the 24 year. So basically the plan is, if you go back to claim the R&D credit, those have to be amended. So any of the open tax years, whether that's 22 and or 23, but as far as 174 goes, that all gets captured on that positive 481A adjustment, all gets captured on that 24 3115.
So let's say I'm a C corporation and I took the R&D credit through 21, thought it was going to get corrected, didn't take 174 serious in 22 and 23. What you're saying is I can go back and claim those credits on those amended returns in 22 and 23, get those credit refunds if I was in a tax paying position and eligible for those refunds. And then the 24 year is when I would start recognizing the amortization on those related 174 expenses from 22 and 23, correct?
Yep, that's correct.
Okay. And I think that's very important. I think, I think there are some companies out there that, and we've talked a lot. I mean, I don't think there's probably not a lot of companies that are sitting there losing sleep on this, but I think there are some that realize, and their CPAs as well, that realize that, hey, we got some major exposure here. And now that we know that, to your point earlier, that this is permanent in terms of 424, 423, and 22, possibly 25, depending on what they do, is that, hey, the IRS is going to start looking at this. They're going to come out with some audit guidelines. They're going to start looking at this. And for some companies, it could be very, very large dollars when you factor 174 expenses versus 41 expenses.
Yeah, I mean, I think the most important thing is to try to do what you can to get in compliance. I always think about Jerry Hamill's advice when he says it's better to argue the number than whether or not you're in compliance. So it's better to argue the dollar figure versus not doing anything, and then the IRS says, well, you were not in compliance at all with this, and clearly you have 174 activities. So there definitely is a great avenue to get in compliance for those taxpayers that, to your point, TJ, to this point, thought that this was going to be fixed either in 22 or 23.
Well, and I think we have some clients that, while 174 amortization is punitive to all our clients, there's certain industries that are just in the crosshairs of this in a very, very, very extreme way. And I think of, a lot of our architectural firm clients, and while they have the R&D credit, okay, there's also some of the times they sub out a portion of that design work to other providers where there's this industry standard language that are in all their contracts with the third party providers. They can't take the credit on. It's not eligible for 41, but they're required for 174 purposes. And I think it's also something that we've been able to work with clients and say, hey, be mindful. You may not think you have 174, but you actually do because of the wording, the verbiage in these contracts. Now, would an IRS agent look at those contracts? We don't know that. But at the same time, I think it's continue to educate clients on, hey, this is 174. This is not 174. 41 and 174 are not equal. 174 is going to be higher than 41 for most companies, I would think. And it's the education piece. But I think the reality for companies is that if you've been in compliance all along, 22 was the most punitive year. 90% of your SREs were added back to taxable income. 23 was still punitive, but not as punitive. Well, if you see if your expenses are consistent year over year, 24 is still going to be some additional tax owed, but not near to the level of the 22 and 23 years.
Yeah, exactly, TJ, because those 174 expenses for the previous years, being able to deduct those on the 24 year, the applicable portions, you're right, it does start to even out, does start to be less punitive and lets them catch up. And then again, for those clients that were not in compliance for 22 and 23, that 481A adjustment over 4 years also is extremely helpful to help mitigate the the bump of additional taxes and to help spread out that tax burden.
Something very important to point out is that we're focusing retroactively, obviously 22 and 23, but back to this term trapdoor that we talk about a lot, is that if you're a taxpayer, remember, credits are permanent, all right?
Mm-hmm.
174 is a timing issue. It's a very punitive timing issue. And I think it's very, I think it's somewhat insensitive just to say that's a timing issue because of the dollars that are at stake for a lot of these companies, especially closely held businesses.
For sure.
But it's something that I think there's an exposure item out there that you're forfeiting a permanent area of tax law for a timing issue. But what happens when they fix this? Because they will fix it. 174 expensing will come back as part of the TCJA 2.0. What I think Dave McGuire, our colleague, refers to it with Republicans. Look, they'll have control DC next year. Is that they're going to bring back 174 expensing? Is that what's going to happen to those companies that basically said, okay, I took the R&D credit in 21, 22, 23, 24, maybe even 25. I didn't. Now that it's turned back on, expensing is turned back on. Now I'm going to start taking the R&D credit. Well, you got exposure there. That's a massive flag. And so that's the thing to keep in mind, I think, for our alliance firms and clients, is that I get it that it's expensive, but you're maybe creating some issues for yourself because you got this trap door out there. When they get back to expensing, allowing 174 expensing, you're going to have to answer some questions under an audit.
Yeah, and to your point, TJ, it's definitely a very delicate balance of, the exposure portion, and then as well just keeping the lights on, because we've seen a lot of our clients, the additional taxes that are owed due to 174 is pretty staggering. So again, it's obviously a very sensitive issue, but at the same time, you still want to make sure that you're in compliance. And then to your point, for future tax planning purposes, that you still leave the option open to be able to claim the R&D credit in the future while mitigating any potential exposure areas.
Yeah, I remember one specific call. And I don't know if you were on this call or not last year. Is that we were talking to a client, and they had gotten approached by a very large national firm years ago to take the R&D credit, and they were a government contractor, and obviously 174 really, really hit them hard in 22 and again in 23. And the owner was extremely had a lot of regret for taking these credits. Now, these credits were well into the six figures. Maybe even up to seven figures in totality since he started taking this credit. But this 174 matter really was giving him a lot of frustration, and so we had to keep reminding him that yes, I understand. Look what you saved in tax dollars over the years, and what you're going to save going forward. And so don't abandon the credit. I understand it's painful, but let's be mindful, and maybe we take a reduced position. To your counsel earlier, David, is that, hey, take something, right. and we can argue about the dollar amounts later, but take something to show that you've made a good faith effort to be in compliance to a certain degree.
That's, again, the name of the game, is just that delicate balancing act of making sure you're in compliance while at the same time, making sure that you keep all options open for future planning opportunities. And that client in particular, again, that's one of those can very heavily sympathize, because if I had to try to pay the tax bill that he was facing, I probably would not be too happy either.
And we've got a lot of color commentary of this over the past 2 years, David, is that it's so unfair that how punitive they've made this on especially closely held businesses. And, in our dialogue with our consulting firm that we hired in DC and discussions with elected representatives in DC, it seems like the Fortune 500 is just not too worried about this. And so hopefully some reprieves coming in this new tax bill that they're talking about in 25. I would even be for, maybe creating a small business. If they don't fix it for everybody, maybe create a small business provision. If you're under, 500 million or $1 billion in revenue, you have the option to elect to deduct, because it does make a huge, huge impact on a company's ability to invest and to, as you said, keep the lights on a going forward basis.
Yeah, I mean, it just makes sense because, to your point, TJ, Fortune 500 companies, it really is just a timing issue for them. They have the capital. They probably have a ton of credit carry forwards to just burn through. But those small closely held businesses don't have access to that kind of capital, don't have access to those types of incentives and credit carry forwards. So for them, this really is a big deal. Again, if 174 does get fixed, hopefully there is at least something for the small businesses, whether that's just making it current deductibility or maybe certain retro provisions for small businesses to help them catch up on the remaining depreciation and be able to deduct them immediately. Hopefully there's something there to really help them, because they've really been struggling with complying with 174.
Well, obviously this whole situation's got a dark cloud over for the past 2 years, but fortunately there is a path to correct. And we would be happy, goes without saying, we'd be happy to sit down and speak to our alliance partners and clients to discuss that and map that out and put numbers to this concept so they can make a business decision. So they're not creating those unnecessary trapdoors for themselves.
Yeah, absolutely. We have, our team is ready and willing to help walk through any of the scenarios that a taxpayer may be facing. So it's something we're always happy to do and talk through.
Okay. Well, David, thank you for your counsel and everything you've done on behalf of this 174 for our clients and CPA firms over the past couple of years.
Thanks for tuning in. Remember to subscribe to Let's Talk Tax podcast channel on YouTube to be notified and receive all new episodes. In addition, we invite you to visit us online at McGuireSponsel.com, Let's Talk Tax podcast, to see today's show notes, technical resources, and links to more about today's content.